But by 2010, it was US again, which had made a big comeback, and this time through the FANG stocks. What's going to happen in this decade? We're already speculating. There are a lot of trends which are visible. Looks like India is one such trend which might happen in this decade. But again, it is not permanent. Every 10 years, the trend tends to change.
Good morning, everyone. First of all, I would like to take this opportunity to thank all the participants who have taken the time out from their busy schedule and attended the session yesterday. I also want to thank ET Markets, who is a media partner, for giving us an opportunity to organize this beautiful event where we had many brainstorming sessions where we learned many things about investing. And I also want to thank our partners who have supported us on for organizing. I mean, in terms of organizing this event. So our title partner is Access Alternates, and we had a platinum partner, Carnelian Asset Management, Vito Capital, Chanakya, which is also known as Step Trade Services. Then we also had a gold partnership with some of the high quality portfolio managers like INB Asset Manager, Buckle Rock, which is also formerly known as O3 Securities, ASK Investment Managers, Prabhudas Giladhar, Sundaram, and Prudent. We also had a silver partnership with two players. One is Aditya Birla Mutual Fund. They also focus on alternates, that is known as Aditya Birla Alternates, and Ampersand. Without their kind support, we would have not been able to reach out to investor like you and would not been able to organize this beautiful event. So thank you so much. I'll discuss about how was the day and what all things that we learned yesterday. It's very important to summarize that, and then we move on to the next day, which is today, in terms of telling you who are the speakers who want to come in and speak to you. So, so yesterday, the first presentation was started by Mr. Manoj from Carnelian, where he talked about Bharat Ka Amrut Kal, where he covered up how the Indian government or the government of India is undertaking the major reforms and how it will impact your portfolio. So it was a detailed discussion on that. Then we heard Mr. Hitesh Javeri from Access Alternates, where he covered up the entire markets, the outlook of equity markets, and whether it's a good time to invest or not. Then we heard from Mr. Ankush Jain, who is from Chanakya Capital, how important it is for you to allocate money in SME stocks. And he also helped us to remove this perception that there is a lot of froth in the SME stocks. When there are good quality SME stocks as well who are doing well, and they migrate eventually to the main board from SME. And that is what we talked about and shared very important data points. Then we heard from Mr. Ashish Sumaya, who is the CEO of Vito Capital. He talked about how and why winner rotates, whether you talk about stocks or PMS or mutual funds. So it is not important that every time you look at the past track record of the performance of last 1 year, 2 year, and basis that you invest your money. It is very important to identify the investment philosophy of the portfolio manager, the style of the portfolio manager, and basis that one has to choose, because not necessary that all the portfolios which you picked up, which would have done well in last 1 year, may continue to do well. In fact, he presented the data points wherein he talked about that the best performing funds of last year may be the worst performing fund next year. So therefore, choosing the fund based on last year's performance or last to last year performance is not relevant all the time. Then we heard from Mr. Vaibhav Sangvi from ASK Hedge Solutions. He talked about the importance of allocating money in long short funds because markets will continue to be volatile. As we move towards $5 trillion economy, the market cap is almost touching $5 trillion as we speak today. We are going to witness huge amount of volatility. Now, how do you make volatility as your friend instead of considering volatility as your enemy, and still continue to generate consistent return, risk adjusted return in your portfolio? And especially for ultra HNIs, though, who prefer to sit on the sidelines can take the advantage of the long short funds. And as in when there is a drawdown, they can deploy their money from long short fund to equity. So strategically and technically, it is very important that we should allocate some amount of money long short fund. And this particular category is emerging very well in India from 2017 onwards. And Weber has been pioneer in terms of doing that in India. Then we heard from Mr. Hitanshu Devnath that since markets have peaked out in terms of valuations, and it's very important that what happens in when we keep investing in equities, when the valuation goes up, we forget to trim down the positions of equities in our portfolio, and we become overweight at times. So it's very important that we trim down the position and strategically allocate some amount of money PMS, which is debt PMS, because there was a time when people used to consider debt mutual funds, but post a new tax regime, now that you don't have an indexation benefit, there are investors who have shown a lot of interest in AIFs and PMSs for their debt allocation also. So he talked about that we're getting a good opportunity to lock your yield at this point of time at a higher end. So why not to lock this up and then strategically start deploying some more money towards that side, because balancing the portfolio is the most important aspect. Then we heard from Mr. Arun Subramaniam from Ampersand Capital that challenges and opportunities in investing in equities, and I emphasize more on challenges because very important that investors should know what are the challenges that you see or they see in front of us before investing, so that once you take the informed decision, then you stay longer in the fund. So it was very important that for us to highlight what are the risks and challenges that we see going ahead. Then we heard from Mr. Nilesh Shah. Nilesh Shah is the CEO of Kotak Mutual Fund. He talked about the next 100 days plan after election. He also talked about the valuation aspect of how India is positioned vis-a-vis some of the other emerging markets in terms of their valuation metrics. He also talked about where are we headed as an economy. He also talked about the stability of NDA government. He also talked about their own plans in terms of alternatives, which the couple of funds that they would be launching going ahead. Post that, we heard from Mr. Saurav Mukherjee from Marcellus Investment Manager. He's the founder and CEO of Marcellus Investment Manager. He talked about the rise of new Indian elite, how the economy is shaping up, how we are headed towards $10 billion economy, and how women power is coming into picture and empowering it, how the economy is shaping up in terms of GDP growth, and discussed and given the different perspective altogether. Then we invited Mr. Sameer Narayanan from Aditya Birla, where he talked about Kal, Aaj and Kal, in the sense that what was the learning from the past, and how his portfolio is positioned and constructed at this point of time, and how is he looking at going ahead. He was absolutely bullish on the Indian economy, and he was not at all concerned that the valuations looks to be stretched. Then we heard from Mr. Siddharth Oberoi from Prudent Equity. He's the founder and CIO of Prudent Equity Asset Management Company, where we had a panel discussion with Siddharth, Jamin, and Anirudh from INV. So Jamin represent Chanakya Capital. He is the vice president at Chanakya Capital, and Mr. Anirudh, who is the partner and research head at INV Assets. All three gentlemen have the track record of delivering three-digit returns in last 1 year. So they were the one who delivered the highest performance. So idea was to read their mind that how did they manage to crack this code of delivering more than 100% returns vis-a-vis the benchmark, which is much below 35%. So the idea was to read their mind and understand how do they manage to do it, and they openly discussed their strategy, how do they do it. And then the last panel discussion that we had was Mr. Pratik Agrawal and Mr. Shankar Sharma, along with Mr. Kshitij Mahajan. Pratik Agrawal is the MD and CEO of Motilal Oswal. Shankar Sharma doesn't need any sort of introduction. He's based out of Dubai now. And Mr. Kshitij Mahajan, who is the CEO of Complete Circle Wealth Solution. All three of them had openly discussed about the kind of risk which is involved. How does the bear market work? How does the bull market work? What are the ways? Who are the villains of Indian equity markets? How the economy shapes up? So we discussed many things. How quant investing is shaping up. So that discussion was there for almost 1.5 hours, and we concluded the day very nicely. And once again, I take this opportunity to thank all our investors and who have joined us from different parts of the world. There are investors I got to know joined us from Dubai, Oman, Spain, US, Canada. So many thanks to all of you that you guys have taken the time out from your busy schedule and attended this session. So this gives us more energy, more power for my team to organize and put up these kind of show every year. So this is our annual event. We keep organizing this where we invite our industry experts, try and read their mind. The whole idea of doing this is to educate and empower you guys, give you more power to all of you so that you take the informed decision and enhance your overall returns. So now I am not going to take too much of time, and let me with me I have Mr. Vikaas Sachdeva. Uh, so Vikas Agrawal, we invited him, so he's going to talk about the subject which is given is that we always often talk about which is the better instrument, investment vehicle. It is mutual fund, alternate investments, or portfolio management services. So we thought who would be better than Mr. Vikas to talk about that, because Mr. Vikas Agrawal brings about almost 3 decades of experience on the table. He was the founding member at Aditya Birla Mutual Fund, and I remember the way we are talking about alternative investments now. Similarly, those days he used to talk about the importance of mutual fund in clients' portfolio. So I would request Manvi to please invite Mr. Vikas, and then we'll start the conversation. So Vikasji, first of all, thank you so much for accepting our request and taking the time out. Truly appreciate that you've joined this session.
Thank you so much, because I think more than a common name, I think we share several common interests. And I've watched your growth over the years. It's been very, very heartening. I think the theme of this conference is Viksit Bharat. Okay, and in case you haven't noticed, Viksit is basically a variation of the word Vikas.
True,
Okay,
true.
so I'm very happy to see you're mirroring the growth in this, in what is happening across you. So thank you so much for having me. Uh, I think this is now, I think your event is now one of the marquee events in the calendar of whatever is happening in the alternate space. I believe yesterday you crossed record heights in terms of viewership, right? That is what, so congratulations on that.
10,000
And I think
members attended.
10,000. Wonderful. And I think it is also because of the content you provide. The last 5 or 6 minutes I've been hearing you about the discussions which happened yesterday. I'm not surprised. And I'm hoping that it will actually double next year. Uh, so thank you so much. I think this is a very evolved platform. Uh, One of the things I thought I should just talk to the viewers before I start off is that change is inevitable. Like they say, the only permanent thing is change. And Vikas has actually helped me change a bit. I'm actually in Pune in Vikas's office. This is probably AIF PMS experts first digital conference, right, Vikas? If I can term it that way.
Thank you for accepting my
So my pleasure. So it's great fun. But I think the moot point is change, and how people adapt to change. One of the more savvier segments you see out there are HNIs. Okay, HNIs and ultra HNIs, and they're usually a little bit ahead of the curve in terms of understanding trends, understanding nuances, and changing accordingly. So before I get into a little bit of discussion in terms of different platforms, I thought it's worth our while. If I can just showcase the slide here. Yeah.
it's visible.
Yeah. Okay. Great. Basically, I wanted to just showcase the changing landscape of HNI investing. You talked about my profile from the very beginning. I just happened to be very lucky and be involved with the mutual fund industry almost since inception. And I'm also very lucky at this point of time to see the energy which is happening in the alternate space. And there's a reason why it's happening. The only two things which I think are constant is not just change, but also rate of change. And I think HNIs are far more adaptable to the rate of change than most of us. So let me just give you a few insights in terms of what I'm going to be talking about. This is broadly, let me talk about change is permanent. I'm going to show you some data. Uh, you know, uh, See, this is something we all talk about, we all hear, and usually, like they say, there is this halo and horns effect. Halo is something which has been very close to where you are right now in terms of a time frame. If it's positive, you'll have a halo effect. If it's negative, you'll have a horns effect. Halo and horn being the angel and the devil, respectively. But if you just peel it back and you look at a longer term sort of a time frame, you will realize that change actually happens in bits and pieces, but it's quite dramatic. And what we're seeing right now, we may not be able to understand what's happening because we're too close to the mountain to see how big it is. But if we just scale back and see what's happening across the globe, uh, let's look at what's happened in the global hierarchy. There have been some permanent changes which have happened in the global hierarchy. Most of us can't even imagine that at one point of time, the UK was the world's largest stock exchange. The London Stock Exchange was the largest till World War One, and post that, I think NYSE came in and took the force. Then you're talking about after that, in World War Two, you had the likes of Germany and the US lead global trade for a century. They became powerhouses. Europe actually became a powerhouse before they were upended by China in the 1990s. Talking about China, China was the chosen one. Everybody and anybody at one point of time started talking about China. Till, of course, recently people started exploring China plus one. Nobody thought anybody could replace China, but now people are talking about China plus one. These are countries, if you just look at companies, way back in the 1990s, you would have been very blessed to have invested in a company like GE, which was the number one company at that point of time. And no doubt GE has grown over a period of time. It's at a market cap of 152 billion today, but it's no longer at the number one position. It's at the 87th position. Okay, this is how fast things have changed. Uh, Let me just take this forward again.
You're not able to move the slides?
I can. Okay, it's not just countries, it's not just companies, it's also trends. We tend to think that India is the center of the universe. It's the sun around which everything else revolves. It's probably farther from the truth than we could ever be. If you just look at decadal trends which have happened, 1950s, it was European stocks which were leading the way. 1960s was the original Nifty 50, the US Nifty 50, which actually led the way. Then you had 1970s, the oil shock which happened. And at that point of time, it was commodities and emerging markets which really, really took off. In the 1980s, you had Japanese stocks. Mind you, at one point of time, Japanese stocks were 41% of market capitalization across the globe. 1990, of course, I think most of us, we were probably born around that time or saw this trend around that time, which was the dot-com boom. So American tech software came from out of the blue, and 1990 American tech to rule the roost. 2000 was again emerging markets, commodities. We had the BRICS phenomena. I think this is a term which all of us are very familiar with. But by 2010, it was US again, which had made a big comeback, and this time through the FANG stocks. What's going to happen in this decade? We're already speculating. There are a lot of trends which are visible. Looks like India is one such trend which might happen in this decade. But again, it is not permanent. Every 10 years, the trend tends to change. Not just that, I think one of the key things which we keep looking at is what's going to happen to the markets. Nobody actually knows what's going to happen to the markets, but one thing we know for sure that there could be external shocks which come in once in a while, or in fact, of late quite frequently, and they derail the markets. So you will find a series of shocks which have been put on the event list, which includes the oil embargo, SARS, global financial crisis, COVID. You're talking about the sell-off, the start of sell-off from the previous peak, how much it has fallen from the previous peak. One interesting thing is if the size of the fall is more than 15%, the market takes a disproportionate amount of time to recover. Otherwise, even in 9/11, when the market had dipped by around 12%, it just took 15 working days for the markets to recover. Okay, so this is something which we can keep in mind, when we make our investments, and this is definitely something which HNIs keep in mind while making their investments. One of the key things we keep talking about, and this used to be the Bible, that there is a negative correlation between equity and bonds. Yeah, by and large it is. But if you're talking about stress and under duress, which is happening quite often of late, the cyclical relationship, the negative correlation between equity and bonds has come down considerably. Which actually defeats the purpose of diversification to a very large degree. And that is something which has now started taking the attention of a lot of people who do asset allocation. Let's talk about volatility. We talk about volatility in India. Let's see the volatility across the world. If you look at any country, there has not been a single secular trend. Each time there's been a peak, it is usually followed by a very sharp drawdown. So to think that one country, one company, one economy will continue to do well and one should just remain invested may or may not be the right decision. Okay, you have to just keep monitoring the volatility. If it is something you are sticking to, you just have to ride the course because volatility is here to stay. Uh, in India, you hear a lot of conversation around market cap investing. Small caps will do well, large caps will do well. I think this data very clearly shows you again the same thing that volatility is part of the norm. So have a diversified asset allocation, stick to the course, and you will find that usually you will make above average returns. There is no such thing as secular returns, and there is no such thing as secular fall. There is one such thing called volatility, which always will affect your portfolio. Let's look at how Indian consumers are now changing. This is something which I think we are fairly well aware of, but when it hits you in terms of data, that's when you realize how dramatic the whole thing is. If you see managed investments versus FDs, I think the initial part of my career we were hard pressed to actually talk about how mutual funds fare against FDs because FDs were the place to go for. Okay, but today, if you see by virtue of a superior growth rate, the managed investment solutions piece is actually starting to nudge FDs in a very strong way. It is expected that in the next few years, managed solutions, which includes AIF, PMS, retirement funds, life insurance, that will actually overtake FDs in a big, big way. Which A talks about the tenacity of savings now getting into more and more productive, ways of living, and the second thing is the evolving Indian customer. Not just that, if you look at the slide on the right, I think all our viewers must be familiar with this. The mutual fund SIP contribution has really increased over the past 5 years. And I think the industry has also done a stellar job by launching campaigns to promote this particular aspect. If you look at how the landscape is changing in terms of how people use cash, for the first time in recent years, you will find that UPI has actually emerged as the most preferred avenue of transactions. So these are percentages, these figures are percentage of GDP, and you will see a dramatic rise in UPI. In fact, UPI is now cross-border, as we are well aware of. If you go to e-tail penetration, we know about retail. This is e-tail penetration. This is the e-commerce piece of retail. It's expected to double, in the next 4 years. So what does this mean? It means that people are more comfortable with online. Okay, there used to be a time where there used to be minimal transactions happening online, but today there are very, very big transactions happening online. Two, people are not worried about transacting. Earlier there was a point where somebody might do this to my bank and I want to pay only in cash. Things have changed very, very fast. This is as far as retail goes. Now let's just go to what the corporate world is seeing, which is where most people tend to focus their attention on. I think there have been several regulatory and business environment changes. Some of them have been proactive, some of them have been reactive. But the bottom line is overall credit to nominal GDP. If you look at India as compared to other emerging markets as well as to the rest of the world, there is a long, long way to go. We still are not used to using credit. We are more used to using internal accruals for growth in an economy. But I think that will steadily change. Now, what used to happen is, see, the main thing is, as the demand for credit goes up, you will find that there will be some shocks coming into the system. There will be avenues which might not find favor because of a variety of reasons. But the depth of the market is now increasing so dramatically that if there is a bank which might not be able to fund a particular sector, there would have been an NBFC coming in. If the NBFC is not able to do it for whatever reason, it's an AIF which is now starting to come in. And we've just seen this trend across Asia. Across Asia, AIFs are capitalizing on the opportunity presented by the banks and NBFCs who are not. There's a regulatory arbitrage which is happening. Also, recently the indexation benefits have been taken away from debt mutual funds, which have added tailwinds to the entire sector. So, what am I actually talking about? I started by saying that change and the rate of change are the two constants. So, in this permanent state of change, I would argue that for whatever the variable, there are good alternatives. And the pun is on the word alternatives. We call that permataga. Permanently, there are good alternatives. Let me explain how. And this is how HNIs are using uh, the landscape at this point of time. So, what are the two basic top needs? This was a survey done by Prequin, I think a couple of years ago, talking about what are the top two needs that AIFs address. This is alternates, these are AIFs. The top two needs have been diversification and low correlation to public markets. Now, if you start looking at each of the investment avenues, the alternates, whether it's private equity, whether it's venture capital, the circle denotes the size of the market. Okay. And what are the top two requirements of investors in each of these? For example, in venture capital, investors are looking at high absolute returns and diversification. Okay, in hedge funds, people are looking at diversification and low correlation to public markets. In private credit, the same. In real estate, it's reliable income streams, stroke dividend yield, and inflation hedge. So there are different needs of different HNIs, but one thing which is coming across in a very common way, that alternates as an asset class is able to fulfill the needs. There are two things which lead to the growth of any industry. One is what the customer wants, and two is what the industry delivers. Here, the customer is clearly asking for what he wants, and the industry is also starting to deliver. So, if you look at some of these avenues which were there in blue bubbles, HNIs are already starting to look at the alternates segment, the alternative segment across different platforms. There's venture capital where they can participate in social causes while also getting higher returns. There's private equity. Private credit has actually turned up to be one of the fastest growing avenues in the alternate space. RE, where the common investor or the HNI investor can actually participate in commercial or warehousing sectors. The long only AIFs, which can actually run very concentrated portfolios because it's a like-minded pool of 1,000 investors who understands risk, is willing to stick their money into a particular fund for a longer period of time, and it's okay for getting concentrated exposure to exclusive stocks and sectors. And last but not the least, long short. We always tend to think long, but there is something called long short also, which helps. If you double click on each of these, and very quickly I'll just take you through. Basically, there are 160 when this survey was done. And there are various asset categories through which you can actually access, a lot of HNIs access a lot of funds. For example, if you look at angel funds, there are three types of angel funds which normally are done: accelerator, social venture, social infrastructure. We talk about venture capital, private equity. Let's talk about private credit since I just mentioned about that. Private credit itself today is available as venture debt, mezzanine funds, performing credit, special situations, and real estate debt. A lot of people still confuse real estate with real estate debt, but this is a completely different high yield strategy which is playing out. Alternates in India, you know, if you see the growth, like I said, if the demand is there and the industry is able to deliver, this is the sort of growth that you're seeing across the alternate space. As of March 31st, 2023, the industry size was around 3,700 odd billion rupees, out of which 3,400 billion odd rupees had already been deployed. Over the last 5 years, there has been a 4x in growth in terms of number of funds and a 5x increase in funds invested. Also, the deepening market can be seen by the fact that there has been a lot of money which has already been deployed. If you look at CAT 2, I think 71% of the money has already been deployed, uh, you know, in terms of what has been committed. How do you participate in the tectonic shifts in the industry? Today, if you look at it, I think mutual funds have now become all pervasive. So people understand that if they have to participate in the capital markets one way or the other, mutual fund is a great way to look at it. But if you're an HNI, what are you doing right now? You could either be a spectator, participant, or orchestrator. And what do we mean by that? Spectator means you're very skeptical about the growth of the market. You're very skeptical about what's happening there. You live in the past. You say that this is very short term. India will again revert back to the mean, and you just keep watching, and India becomes a global power. The other is being a participant. Okay, you basically are growing in the India growth story through the right investments. You targeted the right investments, or orchestrators, people like me and Vikas. basically as manufacturers and advisors, we curate the right products for the investors and give it to them. One way or the other, you will be seeing the growth of the industry. Now, what are the enablers for that? I'm just going to touch upon. We call it the ROSE framework. If you want to enable your entire portfolio to capitalize on India's perma target, there are four things broadly. One is you should have robust risk management. Okay, as an orchestrator, that means as a manufacturer, as a distributor, as an investor, you need to make sure that you have enough risks which are being identified and mitigated. It could be currency fluctuations, geographical bias. Individual decision making is probably one of the biggest risks. Optimal risk adjusted returns, I'll talk about that shortly. Seamless experience, I think everything is digital, whether it's getting information or investing. That's one of the biggest enablers to capitalize on India's perma target. And of course, emphasis on quality. Now, let me very quickly take you through how this is being viewed by the HNI category. And this is data. We keep talking about something which is very concentrated, equal to which is being very volatile. This is a 30-year study done by Morgan Stanley, no less, from the period 1980 to December 31st, 2021. Okay, conventional portfolio of 100% bonds, 50% bonds and stocks, and 100% stocks. Now, to each of these added hedge, equity neutral, private equity, and real estate, just 20%. So to 100% bonds, you added 20% alternates. To 50-50 bonds and stocks, you again added 20% alternates. Bonds became 40, stocks became 40. And 100% stocks, you blended it with 20% alternates. The same alternates base, but different proportion in terms of asset allocation. Across the board, you would see double-digit decrease in volatility and this is the benefit of adding alternates to your portfolio. Over a longer period of time, it brings down volatility and improves the return potential. From the ROSE framework, this is one. The is on quality. Two of things, and this in terms of what stock happened, but what is data? There is something called factor investing, and I'm sure all of us know what factor investing is. Broadly, we're talking about factors like quality, value, momentum, volatility, size. These are the factors which are typically used. Now, defined, there are indices on quality right now. Rolling return of the quality indices. Quality indices are quality stocks which are picked up from a broad-based index. Index, 30 stocks or quality stocks would have been picked up from the Nifty 100. That's what is quality 30. Just to labor the point a bit more, each of these indices of quality outperform their parent indices over a 5-year rolling return period for periods as large as 82% of the time, 38% of the time, 89% of the time. The more broad-based the index, the more the outperform. All you need to do, for example, if you are comfortable doing it, select quality stocks, talk to your advisor, select quality stocks or a portfolio based on quality. Chances are 4 out of 5 times you would be doing right. Just a very quick thing about Sundaram Alternates. We are here to harness Parma Taga. This has been a growth over the last 8 years. We've grown at a CAGR of 27%. This is a senior management team. That's me, my head of alternate credit strategy, Karthik Atraya, and 9 unique strategies in PMS in AIF and 5 unique strategies across private credit. Recently, we've also launched a debt PMS, something which I think my colleague Hitangshu Devnak would have spoken about yesterday.
Yes.
These are the awards which we won. And yeah, I think this is what it is, because I thought I'll just very quickly give an insight in terms of what HNIs are doing today in terms of investing across the. I hope that was useful.
Yeah, very much, very much. It was a great presentation, a lot of insights. Because my only question is that, and which I keep getting from a lot of investors, because we are in the business of talking to clients, is that what is the technical difference between mutual fund, AIF, and PMS? Because you spent almost 3 decades now in the industry, and you work with large organizations, and then always headed at you work with Enam as a CEO, you work with Edelweiss as CEO. So you set up various products and their investment philosophies, etc. So maybe technically, if you can just throw some more lights on it.
I have a few slides. I'm just trying to project them. I'm not sure whether they're visible. Are they visible?
No, they are not. Yeah. That's right.
Okay. Yeah. Uh, so I'd just like to start off with just very brief discussion, but I'd just like to start off is these are not substitutes. So it's not that if you have mutual funds in your portfolio, you drop everything and you start buying alternates, or if you have 100% alternates in your portfolio, you're missing out uh, by not investing in mutual funds. It is all up to your risk appetite. But more importantly, it is not an either or situation, and I'll explain why. Because I talked to you about changing landscape. You asked me a question about AI versus PMS
Yes.
versus mutual fund. It all boils down to what the customer wants. So basically, AIFs is a pooled vehicle of not more than 1,000 clients. And what AIFs cater to in terms of requirement from HNIs, AIFs can give access to innovation. There are various vehicles. For example, today, if you want to invest in a robotics venture based out of the US, probably AIF is the only one which can do it for you. The other is non-standard treatment. This is a like-minded pool of 1,000 investors which is coming. Okay, so you could actually have a very focused, not a generalized, but a bespoke treatment which you can give for these 1,000 investors. Access to the best minds. There's been a lot of migration to the alternates industry. Okay, and of course, curated products. Products can be curated. The regulation today allows you enough flexibility to create sandboxes, and this is exactly what an HNI needs. If you realize what we talked about, diversification and low correlation to public markets is what they want. And actually, that is visible. If you see the allocation of AIFs in an it was few years ago, and it's expected to become 29%, between 5 to 15%, 29% in the next few years. Why PMS? Again, this is curated portfolios. We could actually curate portfolios depending on what the investor wants. It's an unbundled investment avenue. Every single cost is present out there. Even if a stock is bought, what price it is being bought at, what brokerage is being paid, it is probably one of the most transparent investment avenues at this point of time. Again, access to the best minds. But one of the reasons people invest in PMS is there's a very strong emotional engagement. You see, whenever a stock is bought or sold, it's bought or sold in the client's demat ID. So the client gets a message: this stock has been bought, this stock has been sold. And the client is so emotionally engaged, he thinks it's his own decision. He will question the fund manager, he will get very actively involved. And I think that is one of the reasons why this has become very popular. While mutual funds, I think I will probably be preaching to the converted here, but it's simple and convenient. You can invest with a very small investment amount, professional risk management. Tax benefits still exist. There is, if you churn your portfolio, there is no tax to the investor on that. And of course, lower transaction costs. So if I have to just show you the last two slides in terms of AI versus PMS versus mutual funds,
Yeah.
this is how the active investor plays the market. Up to 10 lakhs should be a mutual funds, and the 10 to 50 lakhs is direct equity, MFs or retail advisory. But when it crosses 50 lakhs, most people tend to actually get into either discretionary PMS, or they are also looking at unlisted equity. And 1 crore plus, of course, there's a plethora of investment avenues available. Uh, I just talked about this earlier. Just one thing here, you will find that the alternate assets AUM at this point of time is growing extremely rapidly. In fact, if numbers are to be believed, the CAT 2 debt portion is almost equivalent to the HNI debt portion of mutual funds, and this is just in 10 years. This is my last slide. I
Yeah.
think this tabulates everything in terms of mutual fund, PMS, and AIF. In period types, we are very lucky as investors in today's day and age that we have so many choices. There used to be a time and place where we had virtually no choice and we had to just be doing whatever was available to us. So that's pretty much what it is with us.
Great, great. Thank you so much, Vikas. It was a great insight again. So thank you so much for sharing these data points. I hope that our investors would find it very relevant while taking the decision, which instrument to choose. So thank you so much once again. With that, we'll like to conclude the session here.
Thank you, Vikas. Thank you, everybody, for